Well, welcome everyone to tonight's asset protection webinar. For those of you that are joining us for the first time, this is we've been teaching this webinar series for well over 10 years, and traditionally a week or two right before tax season, we always have Scott on. And Scott, I think you've been doing this. I haven't counted it up, but it's been over 10 years. We kind of have a date for taxes to go over last minute tax strategies. I sure appreciate your friendship and your help over the years. You've been a great resource for us at Protect Wealth. I'm excited to have you here, but let's go through just a couple quick little announcements before we do. We've had some incredible webinars over the last few weeks. Introduction to asset protection, estate planning. We had Kevin O'Leary on here about 3 or 4 weeks ago. Eric Oliver on cost segregation. Last week was how to protect intellectual property. We went through copyrights and trademarks and patents and trade secrets. All of these webinars are on our YouTube channel. If you haven't subscribed, we encourage you to do that. You simply go to YouTube, type in Protect Wealth Academy, hit subscribe, and that gives you access to everything that we've done. And it's becoming quite a library. And so anyway, I encourage you to do that. We've got 2 live stream summits coming up. We will have live events in the fall. It's just been a little too early for us. And so the next 2 events are scheduled to be live streamed. So they're Zoom calls. That's April 25th, 26th, 27th, and of course, one in June on the 13th, 14th, 15th. These are all 3-day, or they're all Monday, Tuesday, Wednesday classes. In fact, I think everything we teach this year will be that. I apologize for those of you that can't make it, except on a weekend, but that traditionally we can't bring the firepower that we bring on weekends. And so anyway, we appreciate you registering for those classes. This event we've got quite a lineup, and we're excited to have, I think, everybody on the screen, probably plus a couple more. So if you'd like an agenda of what's happening, we'll post the official agenda probably a week or so before the event. We're still working out time slots for everyone, but a very good sample, very good indication of what you're going to learn is on our website. It's on at protectwealth.com. And then before we talk tax and legal, I see we've already got questions coming on. So if you wouldn't mind holding your questions, there's a really good chance that Scott's going to get to anything related to last minute tax tips. But our disclaimer is we really can't get specific to you, even with your questions. If you can ask general questions, we will answer them toward the end of the webinar. I think Scott plans to teach for 40, 50 minutes, and then we'll open it up to questions for you. But if you can hold on to those questions for right now, because there's a good chance we're going to cover it. And if not, at least keep in mind that we can't answer specific questions about you and your specific situation. We can answer general questions. And so try to keep your questions general and things that apply to everyone. What we can teach from here is general strategies, how they apply to you and your specific situation. That's really for you and a tax professional to work out. So with that, Scott, I'm so glad to have you here. You're not doing taxes anymore, but there was a lot of years you did. This was the busy time of year, and we wouldn't have seen a palm tree swaying in the back, and we wouldn't see the are you glad to be out of the tax preparation part?
Yeah, I think, Don, it's been 9 years now, but my tax season used to start very beginning of February, and it would end, right around Thanksgiving. And so it's
Wow.
well, I mean, you have all these extensions coming up and different deadlines for businesses and trusts and individuals and all of this stuff. And when you realize that, individuals can go out till October, it's like, my goodness, don't we ever get a break? And, I think any tax professionals that would be on tonight's call here would say, nope, nope, we don't get a break. We just don't. So
So
it's tough.
Scott, I've looked through your slides, and I'm really excited about this. But before, there's a lot of people on the call that are brand new that have never heard you. Can you take just a couple minutes and tell us a little bit about your background, especially with the IRS, and how you got into tax planning?
Yeah, yeah, absolutely. First of all, is my screen sharing the right way, or do I need
Yes,
to
I
switch
can
it? So,
see it perfect. Yep, this is
all
great.
right. Yeah, that's good. At least the technology is working. But, um, as far as myself getting into it, I started working with the IRS back quite a while ago, and ended up leaving the government back late in '94. And so it's been beginning in '95, I started my practice of trying to help people understand the tax system. Because what I noticed when I was with the IRS and working tax litigation representing the IRS in court is that really nobody really understood any of the tax laws, and so you had representatives coming in there that didn't really understand them, and you had lawyers representing the government, myself included, that didn't really understand the laws, and the judges didn't necessarily always understand them, and so it makes for a really tough environment because you don't necessarily know what you can do and what you can't do and what's right and what's not. And so I think with the gray area and trying to get a comfort level with different individuals, it was challenging for me to be able to work with a whole lot of different small business owners and real estate investors and a lot of stock market traders that have been using Mike's program just over the years have unfortunately, some of these people have some big tax bills, and I saw it again with some folks that, were doing a lot of options trading and didn't pay attention to the fact that, their account was going up by a whole lot of money. And guess what? Some of that was taxable income. And so I think, the education part to me is critical. And it goes with, I don't know, Don, you had that, I don't know, was it maybe 10 different webinars that have been recently done or are coming up. And I mean, that it's pretty impressive because, the taxes obviously is one part. It's an important part, but it goes with the estate planning or the asset protection or, some of these other topics as well. So thank you for having me on to be able to kind of complement some of the other speakers that you have, doing these webinars, because they're really informative to me. I mean, not tonight necessarily as a speaker, but as a student, to be able to get this education. So, thank you for bringing it to all of us.
Well, you're certainly welcome, and it's been a privilege to be surrounded by some incredibly smart people over the years. Scott, in private practice, you've turned around and you've kind of specialized in planning and in litigation against the IRS, and you've sued the IRS
A lot.
a
A
lot.
lot. Yes, yes. But I think let's not think about, having to fight the IRS. I think, tonight let's look at, and so we don't want questions about audits or anything else. Let's look at what are we doing today? I mean, I don't know how the Pendleton household celebrates tax day in 10 days, but one of America's favorite holidays, right? But anyways, let's look at, let me take I guess maybe 30, 40 minutes or so of your time just to go through these slides tonight. Then Don, we can go through the Q&A at the end here and just see where we go. But anyways, thank you everybody for popping on the call here tonight. I know everybody's got other things that they could be doing. And so just want to thank you for joining me for some of these last minute tax tips that we have coming up. And, obviously IRS, we don't want to be dealing with fighting the IRS, dealing with audits, dealing with litigation, dealing with anything in a negative or a sort of a controversial sort of a way. What we want to be looking at here is, what do we need to do today really to win the tax game? And that's kind of a common theme of mine when I do these events, no matter when it is, whether it's 10 days till tax day, or whether I'm doing this in the middle of the summer year, is where are we? Where are we in the year? What can we do as far as planning, knowing what we know today about where the law is, and also knowing that it can certainly change. And I think from a planning perspective, this slide probably shows planning better than anything that I could really say. And that is that this date here is obviously coming up very soon, but think about all the days, in January and February and March. And I used to compare when I was living in Chicago to the days that I'd used to have to shovel snow in January to get to work and get home, and just all of these days in those 3 months. And we still haven't got to the point where we've paid our taxes yet this year. And to me, just think about that we still have another week or two, if we're the average American, before we start working with ourselves. And this really, to me, demonstrates why tax planning is critical for everyone. Obviously, the Warren Buffetts and Bill Gateses of the world, and the big movie stars and athletes and musicians and what have you. Well, yes, everybody here, I guess, they're making $100 million a year or something. They're going to be doing some tax planning. But for all of us that are in business, no matter how small or large your business may be, if you're working, if you have investments, if you own real estate, if you're investing in the stock market, if you're doing crypto trading, we want to be able to take this 105 days and get that down as low as what the law permits. And how are we going to do that? Well, I think the big problem right now is that when you start looking at retroactive tax planning, typically what I would be hearing if I was working at the IRS is, well, are you talking about tax fraud here? What do you mean retroactive? Like, you want to backdate documents? You want to, come up with more miles? You want to come up with stuff? It's like, well, you can't do that. And of course, the IRS would be right. You can't. And so retroactive tax planning at this point is really, really difficult, because a lot of the tax strategies that we would be using ordinarily, and certainly we could be using for 2022 and going forward, are simply not available. So whether it's, when we're recognizing income, whether it's tax credits, whether it's distributions versus wages on let's say an S Corp or some other flow-through type entity, lots of different planning comes into play. But right now for 2021, this is out the window. So what can we do in the next 10 days? Well, you can contribute to an IRA. So if you haven't contributed to an IRA for last year, you still have time to do that. And this is either a traditional or a Roth IRA. We can also contribute to a 401k by the due date of the return, not including extensions. So as long as the 401k plan was set up sometime last year, at least by the end of the year, we can now fund it by April 15th. And the SEP plan is the only one that I'm aware of that allows to go to the due date of the return, including extensions. So for a lot of businesses, that could well put us into the fall. A lot of extensions would be due potentially in August, but more commonly in September, fiscal year companies. So, there can be a lot of different variations to this theme. But understand that as far as reducing your 2021 tax bill right now, really your only option is going to be to contribute to one of these retirement plans. I've put the 2021 numbers up. I'll show you the 2022 numbers here in a minute. But these are the maximum that can be contributed last year. This gets bumped up a few $1,000, as you can see for 22. It goes up $3,000. But the numbers don't matter, as I've mentioned in a lot of other webinars and live events that I've spoken at, is I don't really care what these limits are, from the sense of we can always look these up. If I want to know, well, how much can I contribute to a 401k this year? Well, that could be $20,000, or it could be a little bit more than that if I happen to be over age 50. It could be up to the 67,000 with a match. These numbers, again, are not relevant to the strategy. And the strategy is, do you want to be contributing to this SEP plan or this 401k? Or do you want to get into other types of IRA contributions? And you need to be aware of the fact that these guys are out there. These guys are available for you to either bring down your personal tax bill or your business tax bill, or maybe both, depending on how you have your business set up. But these are huge, huge value-added plays, in my opinion. And to me, perhaps the best benefit you can get by owning your own business. I mean, just think about this, that with planning, and obviously with enough money, because you're not going to be contributing $61,000 to a 401k if your business is barely scraping by, right? But let's say that your business is doing very well, and now you have the ability to do this. Not only can you get a contribution deduction, so if you contribute $61,000 to a regular 401k plan, or a little bit more if you're over age 50 or age 50 or more, I guess. But now you can get this huge tax deferral. And think about somebody who's 30 years old that could put $61,000 in and have that double several times before they have to pull it out in retirement and never pay taxes on that money until the money's pulled out, until they start taking distributions in retirement. So again, look at this, because to me, it's a critical way of doing some planning, I guess, in a retroactive sense. So here we have example one: single taxpayer, no SEP contribution, doesn't have a 401k plan, so can't make a 401k contribution because didn't have one set up. So gets into this adjusted gross income. Schedule A deductions are going to be your itemized deductions. These are mortgage interest, taxes, real estate, state and local taxes, charity. And for our purposes here, this guy has a $50,000 amount here, taxed at $250,000 as a single individual, is going to pay almost 30% of that in tax. And so, like Don said, I'm not doing taxes anymore, fortunately for my sanity. But if this would have been 10 years ago, and I give you this tax return and say, hey, guess what? You owe $75,000 in tax. Now, maybe you had some amounts paid in, hopefully, but that's a huge, huge tax bill. And now you say to me, well, what can I do? Well, how about if we look at contributing to a SEP? So your adjusted gross income didn't really go down here. Schedule A didn't change. But what we did is we made a $50,000 contribution to the SEP, which kicked back a $19,000, almost a $20,000 tax savings. And so by making this one contribution here, we're able to get this huge tax savings and return on our SEP contribution. Now, how is it so high? Well, the single individual, once your taxable income gets into the six figures, you're going to start seeing your tax bracket going up. And so at a 5% rate, with a 34% tax rate on this higher amount of income at the federal level, the savings becomes real. And for this person, we could have just put this $50,000 into a money market. right, and done absolutely nothing with it. In fact, lost money relative to inflation, but still gained this 39% return based on the tax deductions now. And obviously, you start investing this into whatever, some conservative mutual funds. You could be doing stocks, bonds, anything you want in the SEP. And when I've been able to, maybe take $10,000, $20,000 of seed money and start trading options in a SEP account, that now just keeps growing and growing and growing because I'm not paying taxes on any of the earnings with the tax deferral. So again, think about the retirement planning not only as retroactive to maybe I can gain a few bucks for 2021, but what am I going forward at 2022 and future years? Because to me, that's where the really, really big questions come in. All right, other things I want you to look at for purposes of the 2021 tax return. And again, this is due in 10 days. You can get an extension that'll push you out another 6 months. And a lot of folks I know that are on this call or maybe listening to this in the future are extending anyways. Whether that be because you're waiting on K-1s or other tax information, whether you think that your audit chances are going to be reduced with an extension, which I've found some support for over the years. But again, the IRS disagrees with that, as I've said several times in the past. So whether you agree with the IRS or think that they're going to tell you the truth or not, well, that's up to you. But things that I want you to look out for, because I've been reviewing just some 2021 returns as part of some tax planning for different folks. And just be aware that the rules have changed on the child and dependent care credits and the earned income credits. And when I say changed, means change for the better, meaning more people will qualify for more money. So if you haven't qualified for this in the past, you may now. And if you have qualified in the past, you may get a bump up in the amount of the credits. So you can see here that depending on the ages for the kids in this past year, the amounts have gone up considerably from 2020. We're not sure yet what they'll be for 2022, but just be on the lookout that, if you do have minor children, that you may be qualifying for these credits with potential phase out amounts of adjusted gross income. So what this means is that if you're single and your income is between 75 and 200,000, you may have some of these credits go down. And once it reaches 200,000, it goes down to zero. And for married couples filing filing joint, you can double the single amounts. Other credits to be aware of are these stimulus payments in the sense of maybe stimulant payments as well. But stimulus payments, 2021, did you receive this $1,400 per person tax credit? And if you didn't receive that check, you may be able to claim it on the 1040. So that's another stimulus payment that you need to be aware of. And again, if you did get it, fine. But if you didn't get it, ask your tax professional, do I qualify for it? Because yes, there are restrictions on income, so you can make quote unquote too much, right? But if you do qualify, any of these stimulus payments are not taxable income. So you don't have to add back any of the amounts that you've gotten in the past, or I guess may get in the future if any of them ramp up again. These are not taxable income. And don't forget that. Other considerations that I've seen missed quite a bit. I've had several people ask on actually a prior event that I did a few weeks ago about different expenses that employees can take if they've had to work at home, and realize that the home office deduction is not available for employees. So as a part of the Trump tax laws that went into effect in 2018, that eliminated a lot of miscellaneous itemized deductions, including the home office for employees. The home office for businesses is still in play. And that would be something that, again, you want to consider that if you have a business in 2021, do you qualify for the home office? Unemployment comp is taxable this year. So in 2020, there was a portion that wasn't. All of it is taxable this year. I mentioned with employees, again, working at a home, you may have multi-state tax returns to do. Maybe you're working, I've seen this a lot, especially back east. Although if I go back to my hometown in Chicago, people working in Wisconsin or working in northern Indiana or southwestern Michigan may have an Illinois return and an Indiana return, or back east with a New York and a New Jersey return, for instance. So keep that in mind. And then also this bullet point 3, this extra charitable donation deduction. And this applies when you take the standard deduction. So we're not going to itemize. Okay, so we're taking the standard deduction. It's a little bit less than 13 grand for single individuals. Double that, I think it's in the 25,000 range for a married couple. But let's say you take the standard deduction and you don't itemize. Be aware that this little $300 or $600 for married couples kicks in. And so ask your professional, do I qualify for this? Now, this, I think, shows one of the basic premises of tax planning from my perspective is get everything you possibly can. If you get this extra $300 deduction as a single individual, it's going to save you maybe $75 or $100 in tax. So this is not, hitting the grand slam and you can go out and retire. But what it is taking advantage of every single tax deduction that you can. And if you can take advantage of it and you can claim the deduction, why not? So be aware that these are out there. The other thing I want you to be aware of this year is that there's been a lot more transactions done in crypto. And the IRS is, we think, or at least I do, I think of the IRS operating 20 years in the past. That, this is 2022, but they're operating, right at the turn of the century right now. With crypto, though, the IRS seems to be taking a pretty proactive approach. And there's this question on your 1040 this year. And I guess I didn't do a good job of drawing in little boxes here. But at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? So a lot of people are going to be checking the yes box here. And obviously, one of the benefits of cryptocurrency is the privacy and the anonymity that it can offer. But here, you're basically disclosing to the IRS that you did. Maybe you did receive, let's say a Bitcoin, or you sold one, or you exchanged a Bitcoin for something else. So I think a lot of people are going to be checking the yes box. And in a sense here, we don't want to get into checking the no box when the answer really is yes. Again, I don't know what enforcement actions the IRS is going to be taking here, but let's make sure that if we're going to disclose something to the IRS, let's make sure that we're honest about it, that we're not disclosing something or we're not committing fraud anywhere. So be aware that this question comes about, and the crypto tax issues come about as a result either of business transactions or as a result of investments. So let's take a look here quick at example 3. Right, so we go back, not quite a year ago, and I bought 1 Bitcoin on June 1st, and here was the price. I looked about a month ago on March 1st, and here was the price. And so if I go ahead and make this sale, I'm holding it short term because it's less than a 1-year holding period, and I've got a $5,900 capital gain that I've got to pay taxes on when I file new return sometime next year. Now, from that $2,900, if there's any costs associated when either I bought it or I sold it or both, so let's say it was $100 on each end, my capital gain then would be the $5,900 minus the 100 minus another 100, or $5,700. Okay, so just like a stock or bond or a mutual fund, we have to pay taxes on any gains. Likewise, if I would have flipped these numbers around, and let's say I would have bought the Bitcoin for 43 grand, sold it for 37, I would have had this capital loss that I also could recognize just like a stock loss. Now, the other way with crypto is that what if I'm a business and now I'm a business owner, and let's say it's my law practice, and on June 1st of 2021, I get 1 Bitcoin for legal work. At that point, I have to value the Bitcoin. And so I value the Bitcoin. That's where the 37,000 comes to. And I have to recognize that as income. Now, the business, let's say my law practice here, has 2 choices. One, I liquidate the Bitcoin to dollars. I get my 37,294 minus whatever expenses I have, and those would be a business expense. Let's say it costs $100 again. That would be a bank fee or some sort of a merchant fee. But that 37,294 then is recognized as gross receipts for my law practice, just like if I would have received cash or a check or a credit card or PayPal or whatever. Bitcoin is treated the same way. But let's say that I don't decide that I'm going to liquidate this to cash, and I decide I'm going to keep the Bitcoin. I keep the Bitcoin. My law practice recognizes the 37 grand as taxable income, right, as part of my gross receipts. And now my basis in the Bitcoin is that 37,294. And so if I go back to this slide and now take that 37,294 and sell it, I liquidate my Bitcoin and convert it to cash, into US dollars, let's say, I've got a capital gain now of this 5,900. So again, depending on what the business does is going to determine how the Bitcoin is reported for tax purposes. Other things that I want you to consider for this year. And the first thing that we're going to look at is, who are you? Is the question I get a lot is, how do I know if I got a good return preparer? Is she good? Is she not good? And, like most things with taxes, it really depends. And here, it really depends on who you are. For instance, if I was going to look for a return preparer for myself, I can look at myself and say, okay, I'm an employee. I do get a K-1. I don't have a Schedule C, but I get a K-1 from an S Corp. I do have a few C Corps. I am a real estate investor. I am a stock market investor. I don't do farming, and I am retired in a sense. And so I have IRAs, 401ks, and these types of issues. So what I'm looking at here is, I don't want a CPA or an enrolled agent or an attorney who's good at farming, who can do Schedule Fs. That doesn't mean, you could get the very best CPA in the world that knows farming schedules better than anyone else and would be an absolutely horrible choice for me. Just like when I was in the business, when I did it, when my law practice was doing this, I specialized in real estate investors. I had a huge number of real estate investors and a lot of stock market investors. But if you would have brought in oil and gas, if you would have brought in farming, if you would have brought in ranching, if you would have brought in some of these businesses that I didn't know about, I would have been a horrible choice for you. But if you did real estate investing, you would have hit me in the sweet spot. So find out who is doing your return And do they do a lot of returns for people like you, similar situations? Once you get the good return prepared, then we got to start understanding just some of the differences in the tax laws that are available to us. And this is the standard deduction amounts that I was mentioning before. So we're at a little bit over 12,500 here, double that for anybody that's married filing joint. You can see these numbers go up, 400 here and 800 here. But these are the amounts that you have to have in excess of before you're going to itemize. So if you don't itemize deductions, then we can add to this that charitable deduction, whether it's 300 or 600 or something less than that. Be aware, though, of tax credits. And I mentioned before some of the tax credits that could be available to you, some of the stimulus payments and other credits. But there are a lot of different credits available to homeowners, some to real estate investors, whether it's a second home or whether it may be a rental property. But be cognizant of the fact that HVAC systems, where heating and air conditioning and windows and roofing and anything where we're going to get into something that's a more sustainable or a so-called green type of improvement to your property is going to generate a possible tax credit. And this tax credit, if you end up, let's say, with a $1,000 tax bill and you can get a $300 credit, you're now only going to owe $700. So you're going to get a dollar for dollar reduction in your taxes. And anything we can do on that, let's make sure we maximize the credits. Let's also make sure that we understand that the student loans, and this again is in a state of flux. And I have no idea. I've been following this because I have kids with student loans, and I really have no idea what Biden's plan is on the student loans as far as, is there going to be any more forgiveness of student loans? Because I haven't seen that up to this point. If there is, though, any student loan forgiveness is going to be exempt from federal income tax. So anybody out there that has student loans or maybe knows somebody that does, this is something we want to be on the alert for, that we don't end up paying income tax on any student loans debts that are forgiven. Claim everything that's available. Now, of course, this means that you need to have some idea of what's available. We're not going to hold back tax deductions. Well, if I get audited, I'll pull this one out then. No, we're not going to do that. Claim every deduction you're entitled to. If you're entitled to a home office for business, claim it. Again, if you have these stimulus tax credits, make sure you take advantage of it. College expenses, tuition and fees, points with a home mortgage. All of these are ones that are missed. It's criminal how often I see self-employed individuals not taking all of their business expenses, not deducting all of their cars or their meals or their supplies or their equipment or retirement plans, or the folks that go out to Vegas, right? I was actually the last live event that I was at was in Las Vegas late last year. What if you hit a big one and you hit a slot machine? Well, you might have gambling losses to offset that. The number of folks that have rental properties and don't claim all of their deductions is infuriating to a tax professional like myself. You need to be aware of what you can claim and don't just settle for, well, maybe I had that or maybe I didn't. You can have rental properties that are cash flowing positive, meaning that every month after all of your expenses, you're getting a check, or your bank account is going up. But your tax bill can be going down with depreciation or with using cost segregation. I know that was one of the webinars that one of Don's experts have recently done. But there's a lot of stuff you can do here. And don't miss the deductions. And don't miss a potential 20% tax deduction with rental properties. This is something that I was doing my own tax return today. And if I didn't know about this, the software that I was using would have missed a 20% potential deduction for some of my rental income. This is a huge amount. And as long as you're keeping separate books and records, contemporaneous in time, meaning you're doing it now, right? You're not waiting 6 months to record this stuff. And all of your hours, notice there's an and here, and all of your hours add up to at least 250 or more for the year, you qualify. Now, why wouldn't you want to take a 20% deduction off of your income from rental properties? It's a potential huge deduction. Don't miss it. And whatever your business happens to be, whatever you're investing in, make sure you get up to date on that particular type of investment. Read up on real estate tax laws. I know it's not the most, stimulating topic of all time, but it's vital for you to be able to win the tax game as far as your investments go. In this case, your rental properties or, whatever else you're doing to generate income. All right. I want to shift gears a little bit with income shifting and, just kind of look at some of the thoughts with how we can do this and gain some sort of tax advantage. First thing I want to look at with income shifting is that we have to have a purpose for doing it. So I can't just say that I'm going to take $20,000 of income coming into my law practice and I'm just going to arbitrarily shift it to another business because it's going to give me a better tax result. No, that's not going to work in an audit situation. What we're looking at here is, are there ways to legally move income around into typically a lower or maybe even a non-existent tax bracket? One way we can do that is with gifting. Now, gifting went up by $1,000 this year. So last year it was $15,000 per person. Another $1,000 makes it $16,000 this year. And we have this big update or sort of an uptick in the estate tax exclusion, going up by $300,000 or so. One of the things that we can do here is that we can use this gifting strategy to gift appreciated assets to somebody else to let them sell them. So for instance, let's say that I bought a stock for $1,000 and it's worth $6,000 now. If I sold it, I'm going to pay tax on $5,000 worth of stock. But what if I gifted that to, let's say, my daughter, or let's go up the food chain to my parent or a grandparent? And instead of me selling it, I gifted that stock that's now worth $6,000 to that person and they sold it. We may be able to shift this income to somebody who's in a 0% tax bracket for capital gains. Or maybe they're in a 15% tax bracket and I'm in a 23.8% bracket. And so I'm able to get the income into a lower bracket. Now, this takes planning, and it is part of, in what I call an intra-family planning that has to be worked out as far as gifting with kiddie tax issues. And so this doesn't always apply to kids that are 18 years old or younger. But it's something that you want to be looking at. Maybe you gift assets that are going to kick out income that is not going to be taxed. For instance, maybe municipal bond interest, or maybe stocks that are not paying any dividends. So with proper planning, you can gift up to this $2,300 of investment income and have the kids pay the tax. Gifting also allows you to not only plan for today, so you make the gift, today, it's like, fine, it's effective today, but it can plan for the future. And so once we make this gift, we get rid of this gift not only from the estate here, right? So if we're trying to do estate planning and we want to get rid of this Microsoft stock or something else that we think could go up quite a bit in the future, but we're also taxing the future gains, the appreciation here at a lower bracket. Somebody who, let's say, I have a lot of money, but my kids don't. Well, I may want the gain on that stock to be taxed future rather than at my rate, which could be as high as, whatever the maximum bracket is. Unlimited. So the 16K doesn't come in for tuition or qualified medical expenses. So keep that in mind as a way around the $16,000 amount. You can do much more than the $16,000 per year, but it could require you to file a gift tax return. So be aware of that possibility. A few other questions that I get that I want you to keep in mind with business owners. Can you pay your kids to work for your business? Yes, absolutely. You can see that these maximum amounts go up a little bit every year. That doesn't mean that you should have paid your kids $12,550 exactly last year. It just means that this would be the maximum compensation that without any other income, the kids wouldn't have to pay any tax. IRS will be looking at this issue if you get audited. That, it's something that I would look at if I was the IRS, that, is the amount that you're paying your kids, this compensation amount, is it reasonable? And what's reasonable? Well, based on how much time they spent and how old they are, or what their ability level was, any effort they put into it, is it reasonable? But here's how it can play out for a small business. And so this was an eBay business online selling these little dolls. It took in a pretty nice amount of money. Now I'm just giving you this as an example, so I've rounded up different numbers. Had this COGS amount. This is cost of goods sold. So that would have been the cost to purchase these dolls. And then other expenses, shipping, maybe supplies, advertising, internet, I don't know, whatever else was. But you added it all up, and this business is ultimately going to get taxed at about a 30% rate. Some of that going to the IRS, some of it going, in this case, to the state of Colorado. And so your number could be more or less than this 30%, but whatever. So this business owner says, wow, I'm going to pay 27 grand in tax on that. What about if I hired my kids? And so we put this into play, and this is how it would have played out, assuming that for an age 15 and a 17-year-old here, that paying them $10 and $12 an hour and having them work 15 hours, a week, or in this case, 25 times 40 or 1,000 hours a year at $12 an hour, assuming that this 12 and this 16, this 12 and this 6 are right in the sense of being reasonable, then we come up with this other deduction, and the other deduction of $18,000. Now, there may be employment taxes and whatever, but just for our purposes here, by paying the kids, and again, assuming this is reasonable, they really did the work, here we're able to effectuate a $5,400 tax savings for the family. So at a lot of the 3-day events, whether it's virtual or whether it's live and in person, a lot of the focus, not only for the speakers, but for a lot of the students and the attendees, is intra-business. Like, how does my LLC work with my S Corp, work with my C Corp, work with my personal? And that's all really important, certainly important from a tax perspective. But what a lot of people don't look at is the intra-family. How can we use different family relationships in business, in investments, with real estate, with other types of structuring, so that we can get a maximum tax benefit? And this is something that that hopefully that, as you're pursuing further education on this subject, keep that in mind, that not only do we have to make sure that all of our business structures and entities make sense, that they're all, the puzzles all fitting together, but also that the way we're using our businesses and our investments with our family members becomes really, really important, in my opinion. Business tax strategies, you'll see this is the same as I've had, multiple years, in the sense of you really need to have a business to be able to maximize your tax benefits. So having a business, having a tax plan in place, and getting a team together, whether that's your preparer, whether it's having an attorney, whether it's a CPA, somebody has to understand taxes. And if it's not you, you better have a good tax professional. I put a couple things in red here because the QBI issue, which we've done entire events on, the seminars on, with C corporation taxation, both of these come into play on how you're going to structure your business, whether it's a new business or whether it's an existing business. So be aware of the options that you have, and be aware of all of the tax deductions. I've written entire courses and manuals on this so that you don't miss anything. You don't miss your automobile. You don't miss your meals. When you can come to one of the events this fall that Don is going to be putting on and Kendall's going to be putting on, and you can deduct travel expenses, your hotel, all of this type of stuff, along with personal expenses. Get a chunk of your utilities. Get a deduction for your computer and home office. Understand your choices and have a coordinated plan. You've got to be able to put the puzzle together so that it makes sense for you, because not everybody's the same. We've got several hundred people on this call tonight. And again, I want to thank everybody for taking time out to get educated on the tax stuff, but there's several hundred different tax plans that if I was going to sit down with the several hundred of you that are on again tonight, we'd be all over the place. Some of you would have net operating loss issues in a C Corp. Some of you would have employment tax credits. Some of you would be going back to look at prior returns, or if I can go back to that prior slide, all of these different tax deductions that are available to you. We would be looking at business meals, and this isn't a typo. It is 100% this year, not 50%. But again, entertainment is out. But whether it is all the business meals, whether it is the equipment you're buying, whether it is maximizing your automobile deduction. Notice you're seeing a lot of these issues as far as the depreciation being the same. Most small businesses don't max out their Section 179. So pretty much any asset that you're buying, computers or furniture, or equipment, anything for your business, we're going to be able to write it off in full this year. But again, that's part of your coordinated tax plan. And, with the tax plan comes timing issues of when are you going to claim income as taxable? And this gets into, when are you going to take Social Security if you happen to be getting to the point of retirement? How are you going to claim capital gains if you're selling real estate? Are you going to use an installment sale? Are you going to use a like-kind exchange? Are you going to use a retirement plan or other tax-favored investments, annuities, Roth IRAs, any retirement plan contributions? Are you going to use opportunity zones, which was set into motion by the Trump tax laws and which has been extended or carried into by the Biden plan? So I haven't seen anything that is going to eliminate the op zones. But how you use the IRAs and how you self-direct them can make the difference between, just playing the game and actually winning the game. And that's the focus has to be here on what can you do today, not only for maybe getting 2021 down, but for 2022, what can you do today to make sure that you don't overpay your taxes starting this year at the very latest, right? We don't want to keep making mistakes or not doing everything that we can do to reduce our bill down. All right, a few last minute bullet points here before you agree to file the return and give your professional the okay to e-file the return or do it on TurboTax or whatever. Double check your return. The forms look a little different. It's not drastic like it was several years ago, but they do look different. For instance, the crypto question is in there. Even if you can't pay, file. Okay, don't hold off, because if you don't file the return, you're going to get a penalty for late filing. Once we file the return, okay, even if you don't have the money to pay, you now start the statute of limitations for the IRS to audit that return. If you do need an extension, file for it, but pay the taxes with the extension, because filing for more time doesn't give you more time to pay. If there are mistakes, that's fine. It can be amended. I say fine in the sense of it may not be a good thing, but it's fine that don't worry about if the return isn't perfect. If you file the return and later find out that you missed deductions or maybe you missed income and you owe money, either way, you can file an amended return and either get the refund or pay the tax. And married couples, think about whether it might be better to go separate or joint. This is not anything to do with your marriage. So you can file married filing separate, and that does not mean that you're separating. It may mean, though, that your taxes are lower by going separate than they are joint. Have your preparer just run a quick check on that. My software does it with a click of a button. I would think most others would do it as well. So with those last minute thoughts, I'm going to leave you with a little quote here from William F. Buckley. I like this particular quote, and I think maybe a little harsh on electrocuting everybody who uses the word fair in connection with income taxes, but understand it's not fair. And let's just learn how to play the game, figure out what we can do for ourselves and for our families, for our businesses, to bring our bill down. So that's all we can do about that, Don, right? It's not fair, but life isn't fair sometimes.
Well, it's not fair, but our obligation is still to be honest. So Scott, awesome. All right, we've got a ton of questions, and for those of you, Scott will be with us in 3 weeks. 3 weeks from yesterday, as we start another Asset Protection Summit, of which everyone on the call should have been invited to attend. If you haven't registered, we encourage you to do that. So there's a lot of questions. And so if you've typed them into the chat screen, we're going to ignore those. I'm sorry, I can't do both screens. Type them into the Q&A screen, and we're going to get to them as fast as we can. But we also have 30 minutes to answer questions, and then I have other obligations, and I believe Scott does too. So we're going to go as fast as we can and be as unwordy as we can. Okay. Can I take a distribution from a Roth or traditional IRA the same year and then roll them over to another institution's Roth or traditional IRA? And I don't think you'd ever want to do a distribution. I think you'd simply want to transfer the account to a different custodian. Is that the correct wording?
Yeah, I think so, Don, because the word distribution here has sort of a legal meaning. And so what you'd really want to do is just a conversion and go custodian to custodian. And then that way you never touch the money. And by doing the transfers via the custodian, it's not going to be a taxable event unless you converted a traditional to a Roth. And then you could have a tax consequences then.
So
But
I had
do the conversion.
I did a simple, I wanted to transfer $50,000 from one IRA to another. I contacted the new custodian and I signed a piece of paper with them. They reached out to the old company and gathered and captured the money. That would probably be the easiest way to do it. And
I would agree. And the less that we've got to touch the money, the better, because things can get messed up. You have strict deadlines on rollovers and conversions, and there's a 60-day window out there. And let's keep things very easy for us, and kind of take it simple so that we don't make any mistakes that are going to kick in a big tax bill.
Great. I completed a 1031 in January 2022. Equal or up the value is the rule. If you mess up, you don't meet the value part, and your accommodator didn't alert us to a mistake. Apparently there was a mistake. Can you appeal, let the IRS know what happened? Could you do a partial 1031 exchange? Did the whole thing? Scott, how does that work?
Well, this one would be, this one would take quite a while to answer, but in general, a 1031 exchange is a way for somebody who's got big capital gains to not pay tax on the capital gains and just roll it into a new piece of property. But there's a bunch of rules, and there's a 45-day rule and a 180-day rule. And if you don't meet them, and without getting into the details of this question, if you don't meet those or you fail the deadlines or whatever, sometimes you can get relief from the IRS. But typically what I recommend is go back to the exchange accommodator, the person that's handling the 1031, and see what they can do as far as we may have a partial exchange here, meaning that some of the exchange is tax-free and some of it is taxable. So don't give up on it, because if it's totally, quote unquote, messed up here, what that means is you have a failed exchange, and it would be treated just like you sold the property. So you'd have a capital gain to report, I guess, on the taxes next year, when you file the 2022.
Yeah, I think that's really, really good advice. All right. Mohammed, SEP IRA, in case I have initiated SEP IRA after October 15th, could I still contribute either the employer or the employee portion?
Yes, you could, because this is a SEP IRA.
Yes.
So now we can go to the due date of the return, including extensions, and make that retroactive to the 2021 return.
Even if I didn't set up the account in 2021?
Yeah, although this one it says he did, but yes, you could actually create the account now. A 401k, you could not do that. So the SEP is our only retirement vehicle where we could.
Okay, great. Rachel, you mentioned contributing to my Roth IRA. My understanding is a Roth IRA cannot be tax deductible. Well, that is true.
Yes.
You pay the taxes going in, but it makes it tax-free growth and it makes it tax-free distribution. Yeah, I'm sorry if we said that wrong or if you misunderstood that. Traditionals, you get the tax deduction now. Roth, you would pay the taxes.
Right. Thank you, Don. Yeah, if I misinformed anybody on that, it's kind of you want to pay me now or you want to pay me later? When do you want to pay the taxes? And with a Roth, you're saying, I want to pay the taxes today. And then anything that my investment does from here to 50 years from now, if you can string it along that far, is all tax-free. If you want an upfront tax deduction, then you got to stay away from the Roth and you have to go to just a regular 401k or a regular SEP. And then what you're saying is, I don't want to pay taxes today, and I don't want to pay taxes really in the future, but when I pull the money out and take distributions, then I'll start paying the taxes. And it's really just a question of when do you pay them?
Great. All right. Tell us a little bit about a 412E3 plan. Do we know anybody that can run one, manage it? It's a retirement plan for a really small group of 5 employees or less. Is that
Yeah, I don't know. I don't have anything to do with those types of plans. So I'd be a very poor person to ask about, any of the factors or considerations that you would look at, pro or con, on something like this, where when I get into the different types of the defined contribution plans, like the 401ks or the SEPs or whatever, those to me are just a lot more of what I understand and work with.
I refer most of those questions to iPlan Group. Jill Banner and her group have been excellent at answering questions on that. That's where I would go. If you need a referral, you can go. You can get a consultation with iPlan if you go to protectwealth.com/iPlan. I'll put that in your chat screen, Rachel, if that's helpful.
Yeah, that's actually done. What I would that's what I would do. Is that if I got that question now, I might wait till tomorrow before I shot him an email. But I would go right to iPlan as well.
Okay, Karen is asking, what is a SEP plan?
A SEP is a simplified employee pension. So it's basically a way for employees in a small business, can be just a one-person plan or whatever, can contribute to a retirement plan at a much higher level than, let's say, what a traditional IRA would allow, the $6,000 or whatever.
Okay, great. All right. What does the employer match contribution deadline for 401k match? The extended due date for filing?
Yes, it does. As far as the match goes, yes, but again, with the 401k, it's going to be cut off on the due date of the return. So whatever due date of that particular return was, if it's March 15th, we're out. If it's April 15th, then let's get moving, because we're down to 10 days.
Okay, Gil. Can a contribution to a retirement program help with a large capital gain from the sale of real estate?
Can a contribution, how would this work, I guess?
Would it go to offset any of the capital gain from real estate?
Well, yeah, absolutely. It could, if you've got, I see that. I understand the question now. So yeah, if you had, let's say I had $100,000 gain from the sale of real estate, you've got a capital gain then on your 1040, you could get an offsetting deduction then, not based on the capital gain. In other words, you couldn't contribute to the retirement plan using the capital gain as your earned income. But if you can contribute to the retirement plan, that would reduce your business income, which then would certainly reduce down the amount of the capital gain.
Okay. Rachel is asking about a formula. And Rachel, it really would depend upon your tax bracket, your state taxes. I'm not sure how to answer that across the board for everyone on the call. So on that one, I don't know. Do you have any comments on Rachel's question there?
Yeah, I'm just looking at it right now to see what she was asking. I get what she's saying here. I think what I would be looking at on any crypto stuff, I don't care what the label is as far as Bitcoin or whatever the currency is, how long are you holding it? That's going to be question one. And if it's a year and a day or more, it's long term. If it's a year or less, it's short term. And if it's a year or less, the formula is going to be somewhere between 10% and 37%. And if it's a year and a day or more, the formula is going to be somewhere between 0% and 23%. So that should give you sort of a range as to what it's going to be. And then where you fall in that range is going to depend on who you are and how much money you make. So if you make, $1,000 a year, you're going to fall on the very low end. If you make $1,000 a minute, you're going to fall on the high end.
Okay, great. All right. You were talking about unemployment with being not taxable. What about the COVID relief unemployment? Is that the same?
Same thing. Yeah. I think it was back in 2020, there was COVID provisions, and it was the first, I'm going to make up a number, 12,000 or something like that was tax free. And for this year, doesn't matter what the reason was why you got the unemployment, it's taxable.
Okay. Somebody's asking, that it looks like they've formed an LLC. They have a lot of accumulated expenses, but no income. And I guess it would depend on how you've chosen to tax this LLC. Is it a taxed as a partnership, an S corp, a C corp? That would affect. An LLC doesn't have taxation of it in and of itself. So if it's an S corp, you could show without income, you could show that loss, and that would come down and affect your 1040. Is that right, Scott? If it's a C corp, it would be locked in there.
Yeah, but I'm just wondering about the advice of, if you don't have any income, you don't need to file a tax return.
Right.
I don't think that's good advice. I mean, the question starts with, I've had this business since 2020. I've accumulated expenses, but no income. Well, the first thing is, how is it going to be taxed, like you mentioned? But at some point, do we have a business? Has it started yet? Is it in a startup phase? Is it really operating? And if it's operating, we want to get these returns filed, or let's say file a return for 2021, lock the loss in and pass the loss through to the shareholders, if it's a flow through, sure, or lock it in if it's a C corp and have that carry forward into a future year where there's income. But I think we definitely want to make sure that we're keeping track of all of the expenses, and we need to figure out, are we really in business? Like, why do we not have any income so far? And then I think that'll answer, when do you need to start filing the tax returns?
Yeah, but the fact that you lost money would maybe be all the more reason to file the tax return, in my mind.
Well, yeah. If I have, let's say, a startup business that's an LLC that's taxed as pretty much anything but a C corp. Let's say I have 10,000 of expenses. I'm going to file that return, take a $10,000 loss, and then that can be used to offset, like the prior question, a big capital gain, or maybe my W-2 income, or my wife's income, or my wife's business, or whatever. So I want the benefit of those losses.
Perfect. Scott, when would you suggest gifting versus paying your child from your business for tax reduction purposes?
That's a good question there. As far as the work goes, what is the child doing for the money? And if there's a business relationship to it, in other words, my kids are doing filing for my law practice. She's 15 years old. She's 18, whatever it happens to be. So I can document all of that. From my perspective, I'm better off to call that a wage because I get a tax deduction for it. Whereas with a gift, it's a neutral tax event. So if I gift my daughter $5,000, I don't get a deduction, and she doesn't report that as income. Whereas if I pay her $5,000 in wages, then I get a deduction for that, and she picks up the income, which at her bracket could be at 0%.
Yeah, we got a question that came in on email about children, paying them. You said that you can pay them up to $12,950 if it's earned income, and not have them pay any federal income taxes. Does that include Social Security taxes?
And that's always a maybe question. Yeah. So that's a maybe, it depends answer on the type of entity. So if you have a sole proprietorship, if you have a husband and wife partnership, then we don't have to worry about the employment taxes. But a lot of times, like when I was paying my kids, I was doing it through my law practice, which was an S Corp, and I did have to pay employment taxes.
So S Corp, C Corp, you would have to pay self-employment. Yes.
The employment taxes, the Social Security, the Medicare, which 7.65% for the employee, and then the employer matches. So it's, it can get up there, but it's one of those things where you get a tax benefit, but the government takes away a little bit of the benefit.
Good. If I have a claim a home office deduction for the last 10 years, am I going to have to recapture that depreciation when I sell the home? Does that come part of my $250,000 capital gain exclusion? How does that work, the home office deduction and recaptured?
Right. Well, you're taking the home office deduction now, so you're getting the benefits of these deductions, over a period of time, few years, decade, whatever it happens to be. And then when you go to sell it, depending on how the deal is structured, if you're carrying notes back or whatever, but you can have depreciation recapture there. And typically when you're selling your personal residence here, you're going to have what you mentioned, that $250,000 or $500,000 capital gain exclusion. So you could end up with a small depreciation recapture tax bill, even though you excluded the rest of the capital gains with that exclusion.
Good. Heather is saying, does your children include nieces and nephews? Yes, you can pay them out of your business.
Yep, sure can.
Yep. Bob, what's the best legal structure to use for medical reimbursements, and how aggressive can you get with biohacking for longevity, stem cell replacement, corrective eye surgery, cosmetic dental? Good question, Bob.
Yeah, you can get real aggressive with it as long as we're staying within the parameters of what the IRS permits. And so the IRS has publications on medical expenses and what qualifies as a medical expense for tax purposes. To get the benefit, the maximum benefit there, you're going to want a C Corp taxation, whether that's a C Corp or whether that's an LLC taxed as a C Corp, because anything else that you're going to be using is going to have issues where if there's a reimbursement, it could be taxable income, person that receives it. But again, I take these as, let's just follow the rules. And by looking at the IRS publication, it'll tell you certain things you can do, certain things you can't use. And we just follow that. And I think as long as we stay in line with what the IRS issues there, we don't have to worry about, any audits or whatever.
And the big thing is that it should be prescribed, right?
Yes.
It's not something that, I felt like having these herbs today. And so, no, it should be prescribed by a medical professional.
Yeah, absolutely. Everything should be documented as to why is this a medical expense and why is it not a personal expense? That's really the question.
And Bob, as I recall, it might be your anniversary this month. Happy anniversary. All right. Hi, would kids need W-2s to get paid?
Yes. Anytime you're employing anybody in your business, any employee gets a W-2.
Well, and if you're treating them as a 1099, anything $600 or more, they may not have to pay taxes, but you still have to report it.
Correct.
Them being in a zero tax bracket does not, zero out your obligation to give them a 1099 or treat them as a W-2.
That's right.
Okay. Can you pay your spouse? What's the max?
You can pay anyone you want, any amount that you want. as long as what you pay them is reasonable for what they're doing. So can you pay your spouse? Absolutely. How much should you pay him or her? Well, I don't know what they're doing. So base it on,
Yep.
What is it? What would it, with any employment situation, what would it cost you in the open market to get that done? And if it's going to cost you, $500 to have social media work done, on whatever, on LinkedIn, then you pay your kid $500 to do it, but don't pay him, $5,000, or whatever. I mean, keep it reasonable.
Okay. Scott, we started out with like 25 questions, and the more questions we answer, the more we're getting. So we are going to have a hard deadline here in 10 minutes. So we're going to do the best we can. Is that rollover, can it be tax deductible? Anytime you're rolling funds over or transferring from one custodian to another, this is not a taxable event. Is that right?
Right. As long as we're not changing the type of the IRA. In other words, going from traditional to Roth.
Okay, John, what is the safe harbor amount to pay with the extension?
100% of the taxes that you paid last year. So I guess on the 2021 return, you're going to extend it now. So whatever 100% of the taxes were on the 2020 safe harbor to avoid a penalty for estimated tax penalty.
Okay. Heather, if my LLC was open December of 2021, without any income, do I need to file?
Typically, no, you wouldn't. I mean, if you just open it and nothing happens with it, I wouldn't typically file one. Figure that I would take any expenses that I incurred in December of 2021 and use them as startup expenses on a 2022 return. But again, there's no harm in filing the return other than, it's a pain in the butt to file another return where you may have to pay for it, if you have a preparer that's doing it. But you may lock in these expenses and get moving in the right direction. So again, that would be up to you, Heather, on this one.
So Heather, if you had no taxable events, which is income or expenses, then you don't have to file a tax return. But if we had expenses without income, it may be in your benefit too. Is that fair?
Yeah,
okay.
Yeah, it may be. I mean, especially, I think what I would be looking at is if I had startup expenses that I really wanted to lock in, meaning that I set my business up in December of 2021 and didn't do anything really. But back in July and August and September, I did, a bunch of stuff, and I incurred these expenses. And these are startup expenses that have to be reported on a tax return within a reasonable period of time of opening the business or starting it up. So I may want to lock those in 2021 rather than having expenses from 2021 end up on a 2022 return. I know I'm kind of mumbling around here with all the different years, but it's kind of a timing issue.
Okay. FJ is asking several questions. Should an IRA own an LLC or vice versa for mitigation? And can I jump in on that one, Scott?
Please grab that one.
An IRA can own a single member LLC. An IRA can own an interest in another LLC as long as it's not a majority interest. So it can. Could an LLC own an IRA? And the answer is no. It has to be an individual retirement account in your name. So I don't know. Any comments on that?
No, I think you got it.
Okay. Second question: should a living trust own an LLC or an IRA if you're using both of them to actively put money into investments? FJ, this is probably something. Yes. We have an LLC. Let's say you own 50% of it. What we can do is we can designate your interest. I'm the member all the days of my life. The second I die, I want all my rights and interest to go to, it could be to an individual or it could be to your trust. We're going to cover this in great detail when we get to the 3-day summit, especially on the third day in the afternoon. I'm going to show you how all this kind of fits in. Third question, should a solo 401k be used for active or passive investments? And how does it best fit into your tax strategies? A solo 401 could be used for either one. I don't, Scott,
Well, you
your
might.
thoughts?
Well, the only issue, I mean, is with an active business and a retirement plan, we always
Right.
have to worry about UBIT and tax consequences there. But no, you can do that either way, passive or active.
How does life insurance policy interact with your tax lowering? If it's paid for and if it's deductible out of a business, it can certainly lower your taxes. But if you're paying for your life insurance policy personally, I don't know of any tax deductions personally for that.
No, and we don't, and we wouldn't typically want that because with insurance, we typically want the tax-free benefits if we need it or when we need it. So don't deduct it, and then the benefits become tax-free. So,
Okay.
Don, if I could, I'm just kind of scrolling through. Can I just
Sure.
answer some of these kind of quick here? I mean,
Yes.
I think that might be the best way. Contributions for a Roth 401k, yes, they are the same as a traditional as far as the amounts go. Just remember, Roth not deductible, traditional are deductible. A lot of this stuff, though, we do talk about in the summit, and make sure you get to that as much as possible, because then you can end up like this question here of the beachfront property. This is in Denver, Colorado. You see the ocean behind me, so we're enjoying that part there. But Uber driver, what's the
Scott,
legal?
You don't do taxes anymore, right?
I do not do taxes anymore, only for myself.
You do advice sometimes.
That's right. That's
but,
right.
And you'll always be, or you've been at our 3-day summits for 20 something years. And so, but no, he doesn't do taxes anymore.
Right.
Sorry, I interrupted you.
No worries. No age limit on converting funds to a Roth. So that's not a problem there. You do not need to be an employer to use a SEP. A sole proprietor can use a SEP. Sorry, I'm just going down and popping in some of these answers. No age limit on that. 5-year rule on Roth distributions is from the date the Roth is created. And there's we've got a huge amount of questions here. Don, how do you want to take this? We've got 2 more. We've got 2 more minutes. Let's take the last couple here.
Do the best we can, and Scott will be at our 3-day summits. He'll be talking about how to reduce your business taxes and your personal taxes. So we do the best we can, Scott.
But this is the thing, Don, and this is one of the really cool things about the 3-day events. But just some of the questions here, some that these are like you're thinking so far out of the box.
Yes.
Which is so cool. Like, and I'm going to just use one of the last questions from Kimberly here. Does pay your children also include foreign exchange student? Now, I've been doing this for 25 years now, and I've never gotten that question ever. And I've had a foreign exchange student who's now like a really close member of my family in Paris, but I've never had that. And the answer would be yes, it would. As long as, again, what you're paying that student is reasonable. But think about the foreign exchange student. Now, first of all, assuming that they can work, okay, because when I had a foreign exchange student, she wasn't allowed to work. But assuming she could, now that income isn't even going to be taxable in the United States. So we might even get a huge benefit there, depending on what the tax laws are for the exchange student. Or Teresa here saying, well, can I claim depreciation this year for rentals that I didn't do in the past? And the answer is yes, you can. And you can go back and amend returns for 3 years. And not only can you do that, you should do that. Because if you don't claim depreciation on rental property and you go to sell it, the IRS is going to say that you did claim it, because the law says depreciation claimed or claimable. And that's that's something that, Teresa, excellent question. This is something that everybody needs to be aware of. If you're not doing something right, let's get to somebody that can fix it and get you going in the right direction from here on out. So, outrageous questions.
You'll have a totally different presentation that I believe will answer a big part of the questions when you come to the summit. And Jess, if you're where do you find good tax professionals that can do your taxes? We're going to have 2 or 3 different solutions for you when you come to the summit. Again, it's 3 weeks away, and it really depends on your tax situation. I love the advice that Scott gave. Find a tax professional that specializes in what you're doing. If you're doing real estate, you need somebody that does real estate. Any other, Scott, we're at the top of the hour. Any other closing remarks here? I know we're not getting to everyone's questions. I apologize for that. Closing comments.
Yeah, that's where I would start. I apologize for not getting to all the questions, but I do answer a whole lot of the questions at the 3-day event. So if I don't get them tonight and I don't get it during my presentation, get me the question again and I'll answer it for you either at the virtual or the live event. So either way, we're good, but I do need to run now. Thank you, Don, for having me. And again, thank you for everybody for spending part of your evening with me tonight. And best of luck. I'll see you hopefully in a few weeks, if not sooner. Thank you.
The one thing that I've learned more from Scott than anything else is that the requirement that you have tax professionals with you and that you are planning. Thank you, all of you, for being here. Again, I apologize we haven't got all to your questions, but Scott did have a hard line that he had to go to. Thank you for being on tonight. We appreciate it, and we'll be back. Watch for the upcoming webinars. We've always got something brewing that'll have interest for you. And if not, we'll see you at the 3-day summit in 3 weeks. Appreciate it. Thanks for being here. Good night.